afternoon as well.
Who's all coming in?
Ash and myself.
Yeah, you want to get together for dinner on Sunday? Let me know.
We have a dinner Sunday already scheduled, but yeah, we do want to get together. But
Yeah, we'll figure something out.
we'll talk about that after the show. It's noon, and it is time for lumber futures from the free seats. Let me make sure I'm looking at the camera here. There we go. Greg Kuda, Westline Capital, Mike
Hello,
Wisniewski
hello.
from Materials Exchange, and this is Lumber Futures from the free seats. We got a lot to talk about, so
Yeah, I mean, a lot to talk about for a seemingly boring market with lumber, where and I knew I forgot something. I was going to update the volatility charts, and I forgot to do that. But lumber has been relatively, all things considered, been relatively muted. We haven't had the continuous limit up, limit down days here.
this is true. And it's a tale of two markets. I mean, every time we hit this point, I bring it up, but May just expired, and now we're July. So all the numbers that we're going to talk about with futures, at least in the front month, we're talking about wood that is being priced for a delivery, August 1st or so.
Yeah, and I think what was interesting with expiration last week, May went off at 9:20, and I think that it was at least a surprise to the sawmills that maybe our 1070, 1080. I think the last time we spoke last Tuesday, pricing was still in that 1070 to 1100 area. And now, one of the big majors is 1010, 1020 this morning. I've heard numbers in the mid 50s ask. So I think, the reality is May struggling really to get above that 1020, 1025 area. There was volume that was done in the sub $1,000 area. So that became the real market, and it's is slowly being reflected with physical cash, with the mills having to come off here. And now we've got this big basis between cash and futures where July is kind of struggling to stay above this 800 area. So the $1 million question, we always talk about this to the upside. Well, May went off at 920. Does July have to fill that gap now? And I think that's kind of the $1 million question.
This is true. So why don't we bring up your? There we go. Let's bring up the deck and
all right, let's go. Let me get over here.
take it away.
So I'll just, I know we were just talking about EFPs. I'll come back to all this other stuff. So here's EFPs, 270 for the May contract. So, you're almost a pretty good, and Alex put in here, EFPs tend to have the highest numbers when market is at its highs, 2018, 2021, 2022. So we'll see if this history plays out here again, where if this was the high water mark on the cash charts, on the futures charts, and in fact we have put in the seasonal highs here for May expiration, then this number should begin to trend back down as we get into July, SEP, and November. So something to watch.
Okay.
And then we'll make everybody nauseous here, flipping back through. So just kind of big picture recap here. We obviously had some big down days. Now we're starting to see equities at least trying to form some kind of semblance of a bottom. Bottom to do what remains to be seen. I think the one that jumps out on here, Mike, is crude. And I'll come back to this. But if you look at, here's crude oil, and we always talk about market structure, commodity pricing structure, inverted versus the contango or a carry structure. And crude is just like lumber is the ultimate example of that inverted bull market structure, where here's front month crude oil. It got as high as 115.56 today. So you can see this is the initial start of the Ukrainian-Russian conflict. we had this big sell-off, but you can see how the market is still trying to trend higher, and front month crude at $115. More importantly, when you go out along the price curve in crude oil, this top chart is December 22. The bottom chart is December 23. So you can see D's 22 crude touched 99.99 today, so just under $100. D's 23 is 85.70. So even if you look at the forward curve in energy prices, you still have substantially higher prices. So I'll flip here. Here's RBOB, all-time highs for unleaded gasoline. So
Well,
this is just amazing. This chart goes back, and I wish this doesn't do it justice, but this goes back into the mid 70s, and we're at all-time highs in unleaded gas. On the precipice of highs. Just in other commodities like wheat. So going, and I'm sorry. Here's wheat. So wheat basically traded up to 12. It filled the gap today at 12 in the 1275 area. It got up to 1280 here. But you're at all-time highs or close to all-time highs in a lot of different commodities outside of lumber. So I think, going back to, we had CPI, PPI last week, the big, headline type numbers. We're starting to show signs of moderation as far as CPI, PPI, but the idea that we're just going to see this demand destruction and collapse in commodity prices, I think is wishful thinking. Best case scenario, you go sideways at 40-year highs in inflation. But when you look at unleaded gas, you look at crude oil, you look at wheat at or near all-time highs here, where's this moderation going to play out for the average consumer? Just you look at your core goods, food, energy. I don't see, I guess best case scenario is a moderation, but I seriously, I don't see the empirical evidence to suggest that right now.
Lumber traditionally has led the overall economy somewhere from 12 months to 24 months.
Yep.
And guess what? Like 18, 24 months ago, we were talking about, what happens when you have higher prices? Well, you bring on more supply and demand destruction. And it didn't happen in lumber. It was, phenomenal how it just kept going. The inelasticity of the demand is what I was calling it. And we're seeing it in these other products.
Yeah.
Look, I'm to blame on this when you start looking at lumber, at crude oil and gasoline. I just got back from a 800-mile road trip to northern Wisconsin and back. Didn't even think about it. I filled up my tank with gas, threw the credit card in, walked away, no big deal. I get back to Chicago, exited the highway, and at the local gas station, it was $6.99 for a gallon of premium unleaded.
Wow.
So it wasn't until the end of the trip that I was like, whoa, what's going on with prices here, right?
Yeah, and that kind of fits into, you got to watch. So you can see this is consumer price index, services. So more importantly, when you own a home, you've got a fixed mortgage rate. Your car payment has a tendency to be fixed, but what about people that rent? Do you have a fixed rent payment? Is your landlord going to adjust for inflation? You look at your food, these different inputs that go into everything. This means something in that you can get, you don't necessarily have to have demand destruction if all these other things can keep pace. But I just find it hard to believe that anybody's wage, outside of a lumber trader, where you have all these variables, anybody that's a salaried employee, I just find it hard to believe that your wage this year is keeping pace with inflation year over year.
No, you're going to have to change your lifestyle a bit or your spending habits for sure.
I know we talked about this last week, and I'm guilty. I know we talked about technical analysis, and we'll kind of get into that next week when we're face to face in person, because then we can, I think, reference charts a little bit more clearly. But speaking of moving averages, I thought this was interesting, where you had the S&P roll under its 50-day and 200-day moving averages. This was as of 5/11. So it's going to be interesting to see if this is an aberration. Then you should get back above these moving averages in equities. If this is a telltale sign that there's more pain to come, then you sell all dead cat bounces back into this 50 and 200-day moving average. So this becomes a massive inflection point as far as equities are concerned. And it doesn't matter if you're looking at the NASDAQ, S&P, or the Dow. These 50 to 200-day moving averages, as they start to roll over and their slope flattens out, then it becomes more likely these become you get these relief dead cat bounce bear market rallies, that you get a lot of aggressive selling into any retest of these moving averages now.
Yeah, I mean, the moving average, it's really an indicator of the trend. It's kind of a dynamic trend line more than anything. And I think what the moving average does for a trader or someone watching a market is it just keeps your brain intact, saying we are above the moving average. We are more than likely continuing to go higher. We are
Yeah,
below the moving
absolutely.
average. It's the trend is saying we're moving down. And if you go back and touch it, is that a change in the trend, or is that just a pullback, that you should sell, or not pullback, a rally that you should sell?
Yeah, and I think again, we'll get into this in greater detail next week, but the slope of a moving average is critical. And an upward sloping moving average versus a downward sloping moving average, that kind of is a telltale sign whether you should be fading strength or selling into strength. I'm sorry, buying strength or fading the strength, or vice versa with weakness. So we did these guys. I thought this was interesting. This is a Bloomberg inflation gauge, and who's the beneficiary of inflation? Well, you've got commodities, you've got gold kind of struggling to stay in the positive here. And then the net losers, you've got NASDAQ, and then you've got crypto. So, and the reason I thought this was interesting, I personally thought, I think with a lot of other people, that crypto would act more as an inflationary hedge similar to gold. It was an alternative investment. But that's been the one hit hardest here. And so when you look at, here's Nasdaq, the Dow and the S&P would be slightly above where this yellow line is, the Nasdaq. So crypto by far is the biggest losing asset here with the surge in inflation. So I thought this was funny. Crypto with the Bitcoin at 80,000, 60,000 versus Bitcoin sub 30,000. It's been a humbling experience, where I think Coinbase put something out last week that 40% of crypto holders now are underwater.
Wow.
Yeah, yeah. We'll jump into interest rates here. Treasury, this is the 10-year. This has pulled back. I think at the high water mark, we were up at 3.13%. We're sub 3% now. And I thought this bottom chart was interesting in that the black line here is current yield curve versus last year, a year ago. So you can see we're substantially higher than where we thought we would be year over year. And even if you did this for the Q1 of this year, you're substantially higher than where we anticipated we would be 1st of January of this year. So interest rates have moved higher.
But
Here's
they seem
your
to, I mean, the interest rates seem to be
moderating.
not, we're not pulling back, but it's kind of like flattening out.
Yeah, yeah. Well, I think a lot of that was the anticipation of what the Fed had to do versus the reality of how they're going to do it. Where you baked a lot of this into interest rates, Fed funds rate, futures kind of surged ahead, and as this begins to play out, you've done a lot of the heavy lifting as far as the yield curve in anticipation of what the Fed is going to do here. So, interesting to see.
Yeah.
Interesting to see. 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 So I know we mentioned we had two interesting earnings today. We had Home Depot and Walmart. These are great bellwether stocks as far as consumer sentiment, consumer spending. Home Depot beat forecasts, and at one point overnight, after Depot's earnings came out, or one point early this morning, the Dow was up over 500 points. Uh, uh, and you could see sales growth up about 3%. Organically they had, I think their walkthrough numbers were a little bit lower than last year. It's going to be tough to replicate last year, but obviously their margins were a lot better year over year, and they were able to pass that on to the consumer, which is good. And then, tale of two cities here. You had Walmart. Walmart completely missed. And let me see if I had the, bear with me I'm going to pull up, it was too much to squeeze in here. Let me find the Walmart.
The thing I saw that I found interesting in Home Depot's report was the growing share of their business that's going to pro contractors.
Yeah. No, that's a great point. I think you definitely saw that. And then you had Walmart, and I think what stood out with Walmart, consolidated gross profit rate declined 87 basis points. U.S., elevated supply chain cost and product mix, consolidated operating expenses as a percent of net sales. So they had higher wages. So again, they got beat up today on the major with the talking heads. Home Depot was everybody's savior. Walmart when Walmart's earnings came out, the Dow was up over 500 and it sold off and was only up 300. So pretty good indicators as far as what lies ahead from a consumer sentiment. What kind of pricing. Where are consumers moving forward with higher costs? And I think Walmart is going to see it first, in the sense that, I think the other thing that stood out with Home Depot was the upcharge of luxury goods, where they had people, instead of buying entry level stuff, the one thing that I read that they were able to get people to go up to the next level. So we'll see how long that continues.
Well, and the more that Home Depot becomes a pro dealer or pro professional builder kind of store supplier, they'll be at the whims of the commodity market.
Absolutely.
One of the things they're forward looking was that commodity prices for lumber specifically was going to stay strong. If you have the price of lumber, that could really put a damper on their earnings.
Yeah, and I know you sent something out via email earlier this week, and then I think I also saw you posted on LinkedIn about PTS, price time shipment, how there was a big, was it a big multifamily in the Ohio area that was taking advantage of, look, we'll give you the business, but we're not going to lock in the prices. We'll give you the volume, but as the material ships, we want price adjustment for current market. And I think that's a great strategy. But I just wonder how big of a volume player you have to be, really, in any building material to take advantage of that.
Well, and then the other thing that builder wanted to do was just have their finger on the trigger and be able to buy in when they felt it was.
Yeah.
But they wanted to partner up. They wanted to give the contract to someone and say, "You're going to get this business, so plan on put me in your order file, but let's work as a team and choose when we want to purchase the material."
Yeah.
Collaboration.
Let me see here. Did I let's see here? So the other big thing that was out this morning.
I think you stopped sharing.
Did I stop sharing? Okay. Yeah. Go back. So the other big one that was out. Let me know when it's back up. There you go. The other big one that was out this morning, NAHB home builder sentiment dropped for the fourth straight month, and their chief economist Robert Diaz basically said we're at an inflection point as the unexpectedly quick rise in interest rates. Yeah, the stuff we've talked about over and over again, where you're at this big inflection point from a organic home building standpoint now.
And I saw Canadian home prices fell for the first time in like forever. I read a little bit about even certain markets in the United States. The home sellers are actually having to give concessions and maybe drop prices.
Yeah, I'm seeing
So,
Zonda had something out that where you're seeing home builders have to incentivize people to continue to buy homes now. And this kind of, again, goes back to, I thought this was a great slide here I saw on LinkedIn, Housing Affordability Index. So year over year, median family income is down 7%. And obviously this is adjusted for inflation. Monthly mortgage payment is up 32% year over year. And then annual mortgage payment to median family income is up 5.9%. So, these are all snippets that unfortunately aren't good for housing over the long haul, where, at the very least, from a single family component, it definitely throws caution into the wind.
and at the same time, we know long term, big picture, we are underbuilt. We do need to build more. But does that mean we need to build more in the next 6 months, 9 months, 12 months? You know, over time, we probably need to add more inventory. But as of, there's major headwinds for lumber or for housing right now, which of course is major driver for lumber prices.
Yeah, yeah, and I thought this one was interesting too. This is from HUD, but Fred. This is, by the way, Fred is a great. I know we've talked about this before, but anybody that wants economic data, um, really globally, as well as, just not only the United States, but Federal Reserve of St. Louis puts out Fred information, and this is where you can get just about any housing data out there since the beginning of time. But this shows monthly supply of houses in the United States. And now, obviously, with some of the headwinds facing housing, you're starting to see this number, this metric bubble back up here.
Interesting. Okay, good.
Last one, and then we'll jump into lumber. This is University of Michigan Consumer Sentiment Index. You can see current level. Um, you're kind of getting into areas now from a consumer sentiment standpoint where, past kind of, you've gotten into these levels. They've been associated with the onset of a recession. So I know the old chairman of Goldman Sachs, Lloyd Blankfein, there's a severe probability of a recession. So, as much as I'm not willing to say it's a foregone conclusion, it's something to watch, and that a lot of the metrics, a lot of the numbers out there now are pointing in that direction, unless there's some significant 180-degree changes here.
And recession is, it's not a good thing for sure, but it's not like it's a bad thing. This economy we had is off the wheels. It's off the rails. I mean, we've been ripping probably too fast. So it's we need to slow everything down. And
Yeah,
sometimes,
no, and again, that's the whole, how does the Fed slow stuff down? Well, it's pretty simple. You take away the quantitative easing, you raise interest rates to slow growth. And this, I thought, was an amazing. This is from Dr. Ed Yardini Research. He put this out where this is basically government revenue, tax receipts, and you can see since the onset of all the free money, pandemic driven free money, just look at this divergence between payroll. uh, Corporate really hasn't changed all that much. The red line is individual income. So all this free money becomes taxable, and that's been, the major beneficiary of the free money train has been the government, with individuals getting all this free money. I mean, just, this has got to, you're going to get this convergence back to reality here sooner rather than later.
absolutely, absolutely. All right.
We could skip this. Just the one interesting thing, again, this is PPI information from NHAB. Building material inputs are up 4.9% since the start of 2022. and then they're up 19% year over year. So this just isn't lumber. This is everything that goes, into building a home. And then we'll jump into lumber here. Here's your May expiration at 9/20. We all know that July was trading at a substantial discount. So, what does this mean? Do we fill this gap back at 9/20? There's big stop areas, in this 740 type area underneath here. Then you can slip slide away into the 725 to 700 area. So lumber really in this 780 to 800 area is kind of at an inflection point where you can either make the case you're going to go back up and attempt to fill this 920 gap, or at least get back into the 850 to 880 area, or do you have more downside where you can just erode into the low 700s, the 700 area?
Right. Or erode down to 500.
Yeah. Yeah.
I look at that and it points, it could go to 500 just as easy as it could go to 900.
So here's a July continuation daily. So again, this was the May contract. Here's July. And then when you look at July on a daily, yeah, you're definitely trying to put in a double bottom here. So, you're bumping up against the 9-day moving average here today. You're actually slightly above it or right at it in this 804 area right now. So, if you can get back above this 815 area, then it really opens up. This orange line is the 200-day, which is an 836. So this 836 to 877 area would be kind of, if you can get above 815, you could have a 50, 62% retracement rally back up into here. If not, then at the very least, you want to see this kind of stay above the recent low, to kind of continue to show that we're at least consolidating and putting in a bottom here.
Well, there's something I want to point out about double bottoms. Double bottoms are really powerful indicators in two ways. Number one, they seem to work as, okay, we just put in a double bottom. That's a strong indicator we're going to move higher from here. When double bottoms fail, that's a major indicator that it's going lower. And the speed with which it could go lower is strong because it just failed one of the strongest indicators of, the market is done going down, which is
Sure.
the double bottom.
Sure. And, this is the tough part, is that, look, July might be the greatest sell in the world. September might be the greatest sell in the world. And there are leading indicators that cash has to come down. But from a basis standpoint, and again, basis is just cash minus futures. Look at the premium in cash relative to futures. You're getting back up to these high water marks over, here's, this is last September. No, I'm sorry. This is September 2 years ago. This is a year ago. You could see it better on. We'll come back to this, but you can see it better. So July is trading at a $282 discount. Cash is trading at a $282 premium to futures. So it's tough, going back to this when you're at this kind of, all this tells me is that if I have to buy something, I want to buy futures. If I have to sell something, I want to sell cash. And that doesn't mean futures can't go lower, cash can't go higher, but we do know that you will get convergence one way or the other. And at 200 and, here's $282 in July, 260, I'm sorry, I'm jumping too fast here. So this is July, we're about $260. September's $290. November's $290. I would rather sell cash and buy futures than sell futures and assume at $300 under cash that, look, they certainly can go lower. And if you're a sawmill forecasting, you might very well have to do this. But from a basis standpoint, the basis is telling us is that if you have to buy something, you buy futures. If you have to sell something, you sell cash, and you take advantage of the relationship between cash and futures.
Yeah, this is that time. in the market where you really need to flip your brain around and say, I just came out of a probably 2 year window where I was running a deficit and I couldn't get material. Now I don't want material. I want an empty yard, because every time theoretically, if we're going to have this convergence, something's going to change. It's more likely that the cash price is going to move towards futures, and futures are going to move up towards cash. But you want to run a lean inventory for sure.
Yeah, and the one thing, the speculative element of this is, we go back to this, the speculative element is that cash has to come down to futures, or futures has to come up to cash. That's the speculative element. From a basis standpoint, all you care about is the narrowing, either the divergence or convergence of basis, depending on what you're doing. So I'm going to say, well, I'm buying July because I think it's going to come up to cash. You're speculating, okay? You're all you care about is the convergence between the two, where July could be a loser, but if July is going to lose at $800 and go to $700, then the basis convergence will ultimately still play out. Cash is just going to come off that much harder. So I think that's the one critical thing when you basis trade. You can't have contingencies where, well, I want to be a basis trader, but I want cash to do this, or cash has to do this, futures has to do this to get the convergence. We don't know which is going to play out. All we know that when you get to these historically wide basis opportunities, that convergence is likely to play out. It's the speculative element that cash has to come down or futures has to go up. No, all we care about is that convergence of the basis. So that's the one thing I want to stress to all the basis traders out there. You're looking for the convergence of basis or the divergence of basis. You're not necessarily speculating on one side has to do this versus the other side. And I know we're getting some. Matt Lehman asked about the new contract. The CME, I know we've talked about there is a new contract coming down the pike. It's going to be a truck-based contract. They're going to change the delivery point. They're going to change the species delivered. Technically, we're not allowed to put any of this in writing yet. And just so everybody's aware, if you're attending the Montreal Wood Convention next week, the CME will be there on Tuesday. They're going to hold court at 2 to 4 p.m. and kind of go through kind of 90%, 95% of what's already been decided upon. They're going to ask questions about the new contract implementation and all that good stuff. They're still waiting for final regulatory approval. We're hoping that happens very soon here, where this gets implemented as soon as possible, where as early as July or the September contract. But this is all in the CME's hands in getting the final regulatory approval to move forward with this new contract. It's not a question of if, it's just a question of when.
And we're going to know a whole lot more after next Tuesday.
Yeah, hopefully. Yeah. So Matt, I don't know if you're going to be in Montreal, but the CME will be there. If not, then by all means, reach out to, we'll give people the contact information of Candace, Allison. The CME wants to hear from you. They don't like hearing from brokers. They like hearing from the actual commercials that use this. So by all means, please reach out to the CME.
I want to just touch on this question here, because I made the comment. Look, this isn't easy. This is tough. These are times where, when rising market, you have wood sitting in your yard and it's gaining value. That's fantastic. These are the times where you have an asset sitting in your yard and it's losing value. And you got to figure out, how do you lose the least amount of money? I want to touch on the transportation issue. Transportation is cleaning up. Rates are coming back down. Trucks are even more readily available. I'm sure you're going to talk about rail car speed.
We can jump in here.
Rail cars are there. You go. Look at rail car stats. They're back to basically normal. So,
and again, this is they update this every Wednesday, so this is as of last Wednesday. But here's the Canadian where, look, I understand that there's still issues. There's a partial embargo coming down the I-5 out of BC. Depending on the sawmill you talk to, the embargo exists, it doesn't exist. Certain sawmills, their rail allocation is up to 75 to 80%. Other sawmills are somewhere in that 55, 65%. It's more difficult to get wood into the desert, into New Mexico, into Colorado. I think the further east you go, I don't think it's that, you have the luxury of looking at other species, but this is gradually improving. And is this going to be a perfect improvement? No, because the CN is a hot mess. Rail is still a hot mess, but there are improvements. And going into this question, I think what gives these big price spikes, and I know, Matt will talk about this later this week, but what gives these big price spikes is I have a just-in-time inventory, but I'm not necessarily building inventory. I'm buying for 2 to 3 weeks out, and then I'll kick the can down the road. Typically, when you get these big price spikes, you have an inventory build above and beyond immediate needs. You see the need to build inventory. And that's the part I struggle with housing, with this industry. Is there a need, given all the headwinds out there, is there a need to build inventory, especially in a declining price structure? I think the answer is probably no. You're going to take your chances. And look, if I have to pay higher numbers 2 weeks from now, 3 weeks from now, then I'll do it. But the idea that you're in investment grade levels, maybe in southern yellow pine, and even southern yellow pine can't seem to get off the mat here, where all these other species are in a declining price structure. So that sense of urgency to build out inventory in a falling market structure, to me, just isn't there. And I think that's the one big difference year over year, where last year you had all this inventory magically show up, guys double bought, triple bought, quadruple bought, and overbought for the year. When you look at this year, I don't see that inventory build out in the field. I don't see it with the Lowe's, the Home Depots, where it's just in time as the business materializes, then we come into the market. So that kind of, to me, portends a stair step down, the kind of the mindset of lower lows, lower highs for 2022 versus that collapsing structure like last year.
Yeah, and markets rise on building inventories, markets fall on liquidating inventories. So I think what you're saying is correct. We're in inventory liquidation mode. Oops, we got that shut off again.
I know we're bumping up against it.
The stats here real quick, and then we'll wrap up here.
Yeah, so I mean, from an open interest standpoint, this is another telltale sign you're in a consolidation phase. This is last Monday. We talked about this last week, how open interest went from this 2,700 down to the 2,443 area. A lot of this was just May liquidation without the need to roll shorts or longs into the back months. Now we're 2286, so we're sub 2300. So, my guess is open interest just kind of flatlines here, and there isn't a big incentive one way or the other where, do I want to buy? Do I want to sell? More importantly, is there a need to do either? And I think this is kind of more reflective in a consolidating market where until there's something obvious to do, you're more inclined just to kind of watch this thing vacillate back and forth, and you can see that CFTC numbers, whatever managed money longs had come in, they got stopped back out. You can see commercial shorts are taking money off the table in that, all right, just go sell the physical cash and then cover the shorts here with this big basis differential. So there's really, there's no, outside of 17 net new managed shorts here, you're pretty much just in liquidation mode all around, and that's reflective in that aggregate open interest change.
Yeah. I look at the managed money numbers and it looks like apathy to me. People don't see an opportunity here.
Again, I think the one positive thing with this new contract is that you will re-engage a big segment of the managed money, where it's going to make a lot more sense as you begin to build open interest. You will bring a lot more traders, both commercial and non-commercial, back into this contract with smaller, notional values. That will be one of the big positive things. It's just, it just got to get this thing rolled out, and then we'll see how it plays out. But that was pretty much, I think, everything I had. I look forward to seeing you next week in Montreal.
Yeah, for sure. We're going to talk offline, but we may have a special meeting or special edition of features from the free seats after that meeting. We'll let you know. We want to get that information out as quickly as we possibly can. But if we don't, then we'll have a full report from what happened at the meeting in 2 weeks. But until then, trade safe, be safe. These are interesting times that we're in. Kind of unprecedented for Greg and I, who've watched markets for a long time. You just don't see these massive spreads between futures and cash. I'm afraid that we could get numb to these numbers, and all of a sudden, you blink your eyes a few times and the basis is at $10, and you're like, how'd that happen?
Yeah, no, I mean, history shows that you don't stay at these differentials for long periods of time. So I think one way or the other, that's probably the likely scenario versus a sustained differential. Again, May just went off the board, so that's the only thing, is that cash is cash and July is July. And what does July have to do with physical cash now? The answer is, from a timing standpoint, nothing. July is August 1st wood. So, you could maintain a wider structure just because the difference is so far out with July relative to cash right now.
What we do know is that the people who are watching this show are not in the lumber market for one period of time and then done. We're going to be in the market come August 1st. So there's a massive opportunity where you can provide to your customers wood well below today's cash market for, extended shipping times.
Absolutely.
So good opportunities out there, without a doubt. So Greg, hang on. We'll end the stream here and look forward to seeing you guys from Montreal next week.